years.
What if you could save this much in interest? That's over 100 grand.
And get this, your entire home loan paid off in just under 6 years. Seriously.
So how on earth is this actually possible? Well, let's dive into the data.
Okay, first things first, we need a starting point. Here are the initial loan details.
So those are the baseline numbers, but the real magic is in the strategy.
The secret sauce? It's a simple but super aggressive two-part payoff strategy. First, you make extra payments every month. Then, you add a big lump sum once a year.
So check this out. An extra 3 grand hits the principal every single month. But that's just part one. Let's see how the second step really speeds things up.
And here's the kicker. Once a year, a $10,000 lump sum demolishes that balance. This whole thing creates what's called a financial snowball effect. It's incredibly powerful.
Now, this is where it gets really fun. Let's look at the interest payments. You can see the huge shift from paying interest to actually paying down your home.
Just look at this. Monthly interest drops from over $1,000 to just over $100.
And that's the whole point. Your money is attacking the principal, not just feeding the interest. You can just watch that balance melt away year after year. It's an amazing timeline.
So what's the bottom line? Let's check out the final numbers. This is your money reclaimed.
A normal loan would cost you over $155,000 in interest. This strategy, just over $41,000.
That's a total savings of more than $114,000. That's your money.
Now, of course, keep in mind, this is just an example, not a real lender quote.
But the key takeaways here are just incredibly powerful for any homeowner to consider.
So yeah, this is way more than just data. It's a potential blueprint for financial freedom.
Which leaves us with one last really exciting question to think about for yourself.
Look at this. By 2026, about 60% of Canadian mortgages will renew, and many homeowners could see their payments jump 15 to 20%. But here's what most people don't realize. There are a few strategies that can dramatically reduce that increase. Let's break it down. Something big is approaching for Canadian homeowners. Between 2025 and 2026, roughly 60% of mortgages across Canada will renew. Many of those mortgages were taken out during 2020 and 2021 when interest rates were historically low. When those mortgages renew, many homeowners may face payment increases in the range of 15 to 20%. Economists call this mortgage payment shock. But here's the important thing. Payment shock isn't inevitable. With the right preparation and strategy, many homeowners can reduce the impact significantly. Now, here's the part that surprises many people. The increase in payments isn't caused by just one factor. It's actually the combination of 3 forces happening at the same time: interest rates, timing, and something called amortization reset. Let's walk through each one. First is something economists call the renewal wave. During the pandemic, millions of Canadians locked in the 5-year fixed mortgages. Now, those mortgages are approaching maturity at roughly the same time. That means a large number of borrowers will be renewing their mortgages within a very short window. Both the Bank of Canada and federal regulators have flagged this concentration of renewals as a potential financial stress point for households. The second factor is rate reset math. Even if interest rates fall somewhat before 2026, many mortgages will still renew about 1.5 to 2 percentage points higher than the rate borrowers secured during 2020 and 2021. According to Bank of Canada modeling, that difference alone can create payment increases in the mid-teens to near 20% range. But there is a third factor that many homeowners don't realize affected their mortgage. Some variable rate borrowers kept their payments unchanged when interest rates increased between 2022 and 2024. Instead of their payments rising, their amortization quietly stretched longer. That means less principal was being paid down each month. When those mortgages renew, lenders often reset the amortization schedule. That reset can cause payments to rise even more. So payment shock isn't just about interest rates. It's about the combination of rates, amortization, and timing. If your mortgage renews in the next few years, there are 4 things worth checking right now. First, confirm your mortgage maturity date and your current balance. Second, estimate your renewal payment using today's rates plus about half to 1% as a buffer. Third, review your amortization schedule to see if it extended due to variable rate changes. And fourth, look at your total housing costs. That includes property taxes, insurance, utilities, and maintenance, not just the mortgage payment. The good news is that there are several strategies that can help reduce renewal pressure. Many lenders allow rate holds up to 120 days before renewal. That can protect you from rate increases before your renewal date. Adjusting amortization can also provide temporary relief. For example, extending from 25 years to 30 years can reduce the monthly payment and create breathing room. Prepayments can help as well. Even modest lump sums before renewal reduce the balance your new payment is calculated on. And it's always important to compare multiple lenders. Different lenders can offer very different renewal options depending on your financial profile. Let's look at a simple example. Imagine someone who took a $500,000 mortgage in 2021. By 2026, their balance might be around $425,000. If their renewal rate is roughly 1.75% higher, their payment might increase around 18%. But with a small prepayment and a slight amortization adjustment, that increase could drop to under 10%. Preparation makes a big difference. Mortgage renewal pressure is coming for many Canadians, but homeowners who prepare early usually have far more options available to them. If your mortgage renews in the next few years and you want to understand